On January 29th, 2026, silver hit an all-time high of $121.64 an ounce. 48 hours later, it was below $75. That is a $46 collapse, nearly 39%, in 2 trading sessions. In a market with a 6-year structural supply deficit, in a market where China's silver imports just hit an 8-year high, in a market where COMEX registered inventory had already fallen to critical stress levels, none of that changed in January. The physical fundamentals were intact, and yet the price crashed violently. That contradiction is exactly what this video is about. Because if you understand why silver fell that hard, you also understand why it did not fall further. It stabilized in the low to mid 70s and has since recovered toward $80. It did not return to $23. It did not erase the entire 3-year rally. That tells you something important about what actually happened and what is still unresolved. One component of the silver trade was repriced, another component was not. Most of the commentary you will find online collapses both into a single narrative, either silver is dead or silver always wins. Neither framing is accurate. Neither helps you make better decisions. What does help is understanding the mechanics, the positioning, the leverage, the real yield dynamics, the physical versus paper divergence, and what Kevin Warsh's arrival at the Federal Reserve actually changes, and what it does not. That is what this analysis is about. Here is the central framework for everything that follows. The silver market is not a single trade. It is the sum of at least 2 distinct trades sitting on top of each other. Trade 1, the monetary premium. Silver is a hedge against dollar debasement, against a politically compromised Fed keeping real rates negative, against fiat currency losing purchasing power over time. This trade is driven by real yields, inflation expectations, and Fed independence signals. Trade 2, the industrial demand premium. Silver as a critical industrial metal in a structural supply deficit. Silver consumed in solar panels, electric vehicles, semiconductors, and data infrastructure at a rate that has exceeded annual mine production for 6 consecutive years. This trade is driven by manufacturing demand, energy transition policy, and physical inventory dynamics. When Warsh was nominated, the monetary premium was repriced aggressively. The market concluded that the specific version of the debasement trade, a Fed bending under political pressure, keeping rates below inflation indefinitely, was less probable under a Warsh-led central bank. That repricing was real, and it was large. What the market did not materially reprice was the industrial demand story. Because Warsh's resume has no bearing on solar panel throughput, EV production schedules, or the rate at which COMEX registered vaults are draining. Those are 2 separate mechanisms. They happen to share a price. And the confusion between them is the source of most of the bad analysis in this space right now. To understand what changed, you need to understand the trade that worked from 2023 into early 2026. The engine was real interest rates. Specifically, negative real rates. When the rate of inflation exceeds the nominal interest rate on safe assets like treasury bonds, the real yield turns negative. Investors holding cash or government bonds are effectively losing purchasing power in real terms. In that environment, non-yielding hard assets like silver and gold become comparatively attractive, because at least they do not erode. From 2023 into mid-2025, that environment was persistent. The Fed had cut rates 175 basis points between September 2024 and December 2025, bringing the Fed funds rate down to 3.75%. Simultaneously, inflation remained sticky above the 2% target. That combination kept real yields suppressed, and it kept the monetary case for silver compelling. But there was a second layer, not just real yields, but the expectation that political pressure on the Fed would keep real yields suppressed even longer. The market was pricing in a Fed that, regardless of incoming data, would eventually bend toward accommodation because the White House wanted lower rates and the debt dynamics of the U.S. government practically required them. That is the debasement trade in its purest form. Not just low real rates, but a structurally compromised central bank that cannot raise rates even when it probably should. Silver went from $23 to $121 on the convergence of 3 forces: the real rate suppression environment, the debasement expectation, and speculative momentum that compounded both. By January 2026, CFTC data showed silver futures positioning at historically elevated net long levels among managed money accounts. The trade had become extremely crowded. When a trade becomes that crowded, it does not need a catastrophic event to unwind. It only needs a credible signal that the core assumption is less probable than it was yesterday. That signal arrived with one name. Kevin Warsh is a former Federal Reserve governor. He served from 2006 to 2011 through the global financial crisis. He came out of Morgan Stanley. He is a visiting fellow at Stanford's Hoover Institution. And critically, he has a 2-decade public record on monetary policy. That record matters because the market did not have to guess about him. It could look him up. What it found was a person who, during the 2008 financial crisis, when the entire world was demanding quantitative easing and near-zero rates, publicly dissented. He warned about the long-term risks of balance sheet expansion and financial repression when almost nobody else on the board was willing to say it. He was a credible hawk when hawkishness was genuinely unpopular. When his name appeared as the likely Fed chair nominee in late January 2026, the market ran through a rapid chain of repricing. The first link: if Warsh chairs the Fed, the probability that the Fed caves to White House rate cut pressure goes down. He has demonstrated institutional backbone before. The second link: if the probability of premature rate cuts goes down, real yields may stay higher for longer than the market had been pricing. Higher real yields raise the opportunity cost of holding non-yielding assets like silver. The third link: if real yields stay elevated, the dollar stays relatively strong. Silver is priced in dollars. A stronger dollar compresses silver's price in dollar terms, even if global industrial demand is unchanged. The fourth link: the trade was already crowded and leveraged. When the core assumption weakens, the most leveraged positions face margin calls. The fastest source of cash in a margin call is the most profitable position. Silver had been enormously profitable, so it got sold. That last mechanism is critical. The speed and scale of the January collapse was not primarily a vote on silver's fundamental value. It was a forced liquidation cascade. CME Group raised margin requirements on silver futures contracts as volatility spiked, which accelerated the selling. Funds that had made 300 to 400% on silver were suddenly forced to monetize those gains to cover losses elsewhere or meet margin calls directly. The result was a price that temporarily overshot to the downside. Silver briefly touched the low 70s, nearly 40% below its peak. Physical buyers in Shanghai, Mumbai, and manufacturing procurement desks did not respond by canceling orders. Physical premiums held. Dealers did not slash prices for real metal. The paper market repriced. The physical market barely flinched. Silver recovered from its intraday lows toward $80 within days. That recovery itself was diagnostic. It told you where the structural floor was once forced selling exhausted itself. This is the part of most silver commentary that is almost entirely absent: the bearish pressure test. Let's do it rigorously. Counterargument 1. Industrial demand is not guaranteed. The silver bull case depends heavily on continued growth in solar panel installations, EV production, and semiconductor fabrication. All three of those sectors are exposed to global economic growth. If Warsh does hold rates higher for longer, and if that causes a meaningful slowdown in global manufacturing activity, industrial silver demand could soften. Silver is not immune to recession risk. The 2009 collapse showed that industrial demand can contract sharply and quickly. Counterargument 2. Technology substitution is a real risk. Manufacturers have financial incentives to reduce their silver content per unit as prices rise. This is called thrifting. The solar industry has already reduced silver content per panel by roughly 70 to 80% over the past decade through metallization improvements. That trend has limits, but it has not stopped. Continued high silver prices accelerate R&D investment into silver reduction or substitution. Copper and aluminum are not as conductive, but they are far cheaper. If silver averages $80 to $100 for several years, substitution pressure intensifies. Counterargument 3. The Iran war oil shock complicates the rate picture significantly. This is the most underappreciated factor in the current environment. Silver's correction from $121 was not driven solely by the Warsh nomination. Beginning in late March 2026, a full-scale conflict emerged involving Iran and disruption of the Strait of Hormuz, through which approximately 20% of global oil flows. Brent crude surged toward $100 per barrel. That supply-side oil shock pushed U.S. inflation from roughly 2.8% to 3.3%, its highest reading in 2 years, per the April 2026 CPI print. The Fed's March 2026 dot plot had already revised its 2026 rate cut projections down to just one cut. Jerome Powell held rates steady at 3.75% at his final April 30th meeting as chair. That elevated real yield environment, driven by a geopolitical shock the Fed cannot control, is a genuine headwind for silver that has nothing to do with long-term fundamentals. Counterargument 4. Speculative capital may take years to fully return. The January crash burned a significant number of leveraged retail participants. When a market experiences a 39% crash, it changes the psychological landscape. Momentum traders who drove the speculative premium in silver from $90 to $121 are not rushing back. CME FedWatch currently shows only a 28% probability of a June rate cut and a 70% probability of a hold. Until the rate cut catalyst reemerges with conviction, speculative capital remains largely on the sidelines. That limits the upside velocity of any recovery. Counterargument 5. Valuation pull forward. Silver at $121 may have simply borrowed from the future. A realistic fair value estimate for silver based on the structural deficit alone, without the speculative premium, might have placed it in the $60 to $80 range. If that is true, the market corrected not to a floor, but toward fair value. Further upside from here requires either new catalysts or the reemergence of speculative capital, neither of which is guaranteed. These are serious counterarguments. They do not invalidate the structural case for silver, but they define the range of plausible outcomes, and they explain why the next phase of this market is more analytically demanding than the previous one. With the bearish case stated honestly, here is what the physical market data actually shows. The Silver Institute's World Silver Survey 2026 confirmed a projected sixth consecutive annual supply deficit of 46.3 million ounces. The 2025 actual deficit was 40.3 million ounces. Since 2021, approximately 762 million troy ounces have been drawn from above-ground global stockpiles. That is not a number that reverses quickly. Above-ground silver takes years to accumulate and is being consumed faster than it is being replenished. Total global silver supply in 2026 is projected at roughly 1,066 million ounces, mining at 844 million ounces plus recycling against total demand of approximately 113 million ounces. That 46 million ounce gap has to come from somewhere. It comes from above ground inventory, and that inventory has been declining for 6 years. On the COMEX specifically, registered silver inventory, the metal physically available for delivery against futures contracts, stood at 76.88 million ounces as of mid-April 2026 per CME Group daily reports. Open interest on silver futures simultaneously stood at approximately 575 million ounces. That implies a coverage ratio of 13.4%. The CME Group itself has flagged 15% as the stress threshold. The market has been below that threshold for 6 consecutive reporting periods. In practical terms, for every ounce of registered physical silver at COMEX, there are approximately 7.5 paper ounces of futures open interest. That leverage ratio creates asymmetric risk. In a physical squeeze scenario, where a meaningful percentage of longs stand for delivery instead of rolling, the pressure on registered inventory intensifies rapidly. China's silver imports in the first 2 months of 2026 reached 206.76 tons, the highest level in 8 years per Chinese customs data. That is not marginal demand. That is a sovereign-scale economy buying real metal at a rate not seen since 2018. The Silver Institute projects physical investment demand rising 20% in 2026 to 227 million ounces, a 3-year high, as price pullbacks from the January peak attract value-oriented buyers. On the industrial side, every major demand category is structurally growing. Solar energy is the single largest driver. Silver content per panel has been reduced through efficiency gains, but the volume growth in global solar installations far outpaces per unit silver reduction. The International Energy Agency projects global solar capacity additions will continue growing at compound rates that require meaningfully increasing absolute silver tonnage annually, even under the most aggressive thrifting scenarios. Electric vehicles use roughly 2 to 3 times the silver of a conventional vehicle in electrical systems and charging components. AI data center infrastructure, a rapidly accelerating category, uses silver in high-density circuit connections and thermal management systems. The supply side offers no relief. Approximately 70% of global silver production is extracted as a byproduct of copper, zinc, lead, and gold mining. Primary silver miners make up only 30% of output. That means silver supply cannot be turned on quickly in response to higher prices the way a standalone commodity might. You cannot build a new copper mine because silver prices are elevated, and silver miners themselves have been underinvesting in exploration for over a decade. These are not speculative projections. They are confirmed data points from the Silver Institute, CME Group, and Chinese customs authorities. The physical market fundamentals are genuinely intact. The question is always, at what price does the market clear? And that depends on the macro overlay, specifically on what Warsh does with interest rates and what happens to the dollar. This distinction is now more important than at any point since 2020. Silver is effectively trading as 2 different markets simultaneously. The paper market and the physical market respond to different inputs, move on different timescales, and carry different risk profiles. Understanding which market you're actually in and which one is driving price is increasingly the core analytical question for silver holders in 2026. The paper market is where the spot price is discovered. It is driven by futures positioning on COMEX, leveraged ETF flows, hedge fund net long and net short positioning, real yield expectations, dollar dynamics, and macro sentiment. It responds to Fed language in real time. It responded to the Warsh nomination in hours. It is a market where a single CME margin hike can accelerate a 30% move in 48 hours because of cascade effects on over-leveraged positions. The physical market operates on a different clock. Industrial buyers, solar panel manufacturers in China, semiconductor fabricators in Taiwan and South Korea, EV battery suppliers in Germany and South Korea do not adjust their procurement contracts in response to Jerome Powell press conferences or Fed chair nomination news. Their purchase orders are driven by production schedules that are themselves driven by customer contracts stretching out 6 to 18 months. When silver dropped to $74 in late January, Chinese and Indian physical buyers stepped in. Physical premiums held. The metal moved. This divergence is not unprecedented, but it is currently at an extreme. The January sell-off created a situation where the paper price temporarily implied a market clearing level that the physical market clearly rejected. Shanghai Futures Exchange inventories declined during the same period that COMEX paper silver was being sold aggressively. Physical buyers and paper sellers were operating in the same moment but in opposite directions. The COMEX coverage ratio at 13.4%, below the 15% stress threshold for 6 consecutive periods, is the clearest quantitative signal of that divergence. The paper claims on silver have been growing while the physical metal backing those claims has been shrinking. That is an inherently unstable configuration. It does not mean a delivery squeeze is imminent or inevitable. Most futures positions are settled in cash and do not result in physical delivery. But it does mean the physical market has a floor that the paper market must eventually acknowledge. You cannot clear physical delivery demand in perpetuity from an inventory that keeps declining without either a price adjustment or a structural change in how the market operates. For investors, this distinction creates 2 very different exposure profiles. Physical silver, whether bars, coins, or allocated storage like PSLV at the Royal Canadian Mint, is anchored to the physical market floor. It has no counterparty risk. It does not face margin calls. The Warsh nomination changed the monetary premium embedded in that metal. It did not change the industrial demand reality underpinning the structural floor. Paper silver products, SLV, futures contracts, leveraged ETFs like AGQ are anchored to the paper price. They will capture every move in the spot market in both directions at full speed. In a period where a single Fed communication event can move silver 10% in a session, that is not trivially manageable risk. The gap between these 2 exposure types has widened structurally in 2026. Recognizing which one you are actually in is not a secondary consideration. It is the primary one. Physical silver is the position least affected by the Warsh transition. The monetary premium component of its value has been partially repriced. The industrial demand component has not. For holders who purchased at significantly lower prices than today, the structural thesis remains intact, and the Warsh confirmation is a reason to recalibrate timeline expectations, not exit the thesis. For holders who bought near the January peak, the honest assessment is that the specific driver that justified those price levels, a maximally compromised Fed, is now less probable. That portion of the premium needed to unwind, and it did. PSLV, the Sprott Physical Silver Trust, holds allocated, audited physical silver at the Royal Canadian Mint in Ottawa and operates entirely outside the U.S. banking and COMEX paper structure. Beyond tracking silver's spot price, PSLV has a secondary return driver worth monitoring, the premium or discount at which it trades relative to its net asset value. During periods of heightened volatility, PSLV can trade at an unusual discount to NAVI. If that discount widens materially around Warsh's first FOMC meeting in June, the gap between market price and the value of physical metal actually held in Ottawa represents an opportunity that does not depend on silver spot price moving higher. SLV, the iShares Silver Trust, tracks paper silver in real time. It will reflect every move in the spot price immediately. In the current environment, where a single Fed communication can move silver 8 to 12% in a session, SLV holders should be aware that bid-ask spreads can widen significantly at the open during high volatility periods. Execution quality during the London-New York session overlap, roughly 8 a.m. to noon Eastern, is generally better than during the first 15 minutes of the New York Open, where price discovery is still catching up to overnight moves. Leveraged silver products like AGQ, which targets 2x the daily return of silver, are not appropriate as long-term holds in this environment. That is not a philosophical preference. It is a mathematical reality. The daily reset mechanism in leveraged ETFs creates compounding decay in sustained volatile environments. A 10% silver swing down followed by a 10% swing up does not return you to break even in a 2x product. The sequence matters. In a market where Warsh's first press conference, the June CPI print, and Middle East ceasefire negotiations can all move silver 10% in either direction within days, leverage compounds risk faster than it compounds returns for most holding periods. The market is now operating in genuine uncertainty. Warsh is expected to clear the full Senate vote the week of May 11th and formally replace Powell on May 15th. His first FOMC meeting as chairman is scheduled for June 16th, 2026. Between now and that meeting, 3 distinct paths are plausible. None of them should be held with high conviction. The bullish path. The Iran-U.S. conflict moves toward ceasefire. Reports as of May 7th and 8th suggest the U.S. sent a framework proposal through Pakistani mediators, and Tehran is reviewing it. If that deal closes, Brent crude retreats from $100. Oil-driven inflation moderates. The May 13th CPI print and subsequent June data give the Fed cover to begin discussing rate cuts again. CME FedWatch currently prices only a 28% June cut probability. If that probability rises toward 50%, which it would if May inflation data surprises to the downside, silver recovers its 85-plus range. The dollar softens. Industrial demand, already running at a pace that is structurally undersupplied, does not change. COMEX registered inventory stays in stressed territory. Silver trades toward $85 to $95, the bearish path. The Iran ceasefire stalls. Oil stays elevated or moves higher. June CPI comes in at or above 3.3%. Warsh signals at his first press conference that he will not rush rate cuts given sticky inflation. Markets repriced to no 2026 cuts at all. Currently a small but growing tail probability per CME FedWatch. The dollar strengthens. Real yields remain elevated. Silver retreats toward the $65 to $70 range as the macro headwind intensifies. COMEX physical demand slows because industrial buyers' procurement budgets tighten in a slowing global economy. The structural deficit narrows but does not close. Silver grinds lower. The volatility path. Warsh takes the chair and immediately signals a new communication regime. Fewer press conferences, less forward guidance, reduced commentary from regional presidents. Markets lose the continuous stream of Fed, signaling they have used as a trading input since 2020. Silver begins moving on hard data prints rather than Fed language. Each CPI release, each payrolls number, each trade balance revision becomes a larger volatility event than it currently is. Silver swings 8 to 12% on data days that previously moved at 2 to 3%. Neither a sustained bull nor a sustained bear market develops. Instead, a wide-range volatility regime that rewards disciplined entries and exits and destroys undisciplined ones. That third path is, in some respects, the most analytically demanding of the three, because it requires no directional thesis, only risk management discipline. The 3 indicators worth tracking across all 3 paths. 1. Warsh's language at his first press conference on June 17th. Specifically, how he characterizes the inflation versus growth trade-off. Inflation credibility first signals hawkish lean. Growth flexibility language signals openness to cuts. 2. COMEX registered inventory. The coverage ratio trend, whether it stabilizes at 13-14% or continues declining, is the most reliable real-time gauge of physical market tightness. A further decline toward 10% creates delivery squeeze risk that paper prices cannot ignore indefinitely. 3. The dollar index, DXY. Silver's dollar price is mechanically sensitive to dollar strength or weakness. If Iran-driven oil inflation resolves and the dollar softens from current levels, silver gets a mechanical bid that does not require any change in rate policy at all. Let me state clearly what changed and what did not. What changed? The expected policy trajectory of the Federal Reserve. The specific version of the debasement trade, a Fed captured by political pressure, unable to resist rate cuts regardless of inflation, is less probable under Warsh than it was under a continuation of the Powell status quo. Markets correctly repriced that assumption. The monetary premium embedded in silver's $121 price partially unwound. That unwinding was painful, but it was rational. What did not change? The Silver Institute's 6th consecutive annual supply deficit. COMEX registered inventory at a coverage ratio below the historical stress threshold for 6 straight reporting periods. China's silver imports at an 8-year high. Global solar installations requiring increasing absolute silver tonnage annually. An industrial base consuming metal faster than mining can replace it, drawing down above-ground stocks that have declined by 762 million ounces since 2021. The error in most post-January commentary, in both directions, was treating silver as a single trade with a single driver. It is not. It has always been the sum of a monetary component and an industrial component. The Warsh repricing damaged the monetary component. The industrial component is structurally intact. That does not mean silver goes straight up from here. Elevated real yields are a genuine headwind. The Iran oil shock has added an inflationary overlay that complicates the rate cut timeline. The speculative momentum that drove silver from $90 to $121 has been flushed out and will take time to rebuild. What it does mean, the easy phase of this trade is over. The phase that rewards holding a simple thesis and waiting is behind us. The phase that is beginning requires understanding real yield dynamics, monitoring physical inventory flows, distinguishing between paper price moves and physical market signals, and sizing positions appropriately for an environment where a single Fed communication event can move silver 10% in either direction. The analytical demands of this market have increased. That is not a reason to abandon it. It is a reason to approach it with more rigor than you needed to from 2023 to 2026. The easy silver trade is over. The analytical phase is beginning. This video is for educational purposes only. All data sourced from the Silver Institute World Silver Survey 2026, CME Group Daily Metal Stocks Reports, U.S. Senate Banking Committee hearing records, April 21st, 2026, CME FedWatch, and institutional research from Morgan Stanley, JP Morgan, Continuum Economics, and Reuters. Verify all data independently before making any financial decision. Consult a qualified financial professional.